Good morning, everybody. Okay, are you there, all of you? Can you listen to me properly? Am I visible properly, audible properly, and everything? Okay, so we are going to start our second lecture of foreign exchange, 100% English fast track batch for November 23 exams. Okay, so I'm assuming that all of you are power packed with lots of like sleep and all your, what do you say, some coffee, some tea, something. Okay, some food. I am a bit late today because I forgot that my son has, imagine, I shouldn't be forgetting all this, but still it's okay. So the help was not there in the morning and he has to go for the exams. So I just thought that I'll take an opportunity to make something or cook something for him because he will have exams throughout the day. Yes? Everything fine. So let's start then. So guys, what I assume is that we did this sum and all of you were fine. What do you say? Mansa, you had a doubt on this question. Are you fine now on this question? Can we move ahead? So the next topic that we are going to start with is exchange rate determination. Guys, we need to cover some portion today properly. Okay, but I will not rush off. Okay, so maybe like even if we are able to cover 3.5 hours, that should be good. So in between, we can take a small break of 10 minutes so that you can have breakfast and all, and then we can resume. Thank you, thank you. No, it is not like, yeah, thank you so much. Good morning, everybody. He's preparing for JEE IIT, okay. So how they prepare, okay, how they prepare, he will be appearing for the exams in 2025, not today. That's what I keep on telling to the students actually, kind of that not, I mean, I don't know whether he'll be, I'm sure, I'm just cross my fingers that he should be able to clear. Okay, but then I tell every 21 days they have exam. Every 21 days they have exam for 2 years non-stop. There would be students who would not be taking it very seriously. There would be students who would be taking very seriously. But believe me, if you are into some curriculum and if you keep preparing every 21 days, you are, and the rankings are provided to them for Bombay, all the Bombay students of that particular class where he goes, okay, for the coaching part, they are provided ranking. Okay, so suppose there are 2000 students in Bombay preparing for the same curriculum, all of them going to appear for 2025. Okay, every 21st day, a Sunday, okay, they have exam. So if you do not know, IIT has got two papers, two levels basically, mains and advance. Okay, so once you clear your mains, then you sit for advance and then only you get IIT. Many people even do not, so there are too many colleges, apart from IIT, there are many more colleges. Okay, but then I just wish he gets either a Bombay IIT or a Delhi IIT or a Chennai IIT. Okay, Pooja is saying I was a JEE student. Oh, so why did you shift, Pooja? Okay, okay, okay. So she knows everything. Okay, that's okay that way. So that, so he has to take seriously. I just keep telling him, students, do listen. Your own son would not take you that seriously because it's like, okay, she's my mom. Chalo, let's not waste time. It was a good warm up for in the morning, since everybody in the morning is very sleepy, including me. Okay, so we slept with foreign exchange and waking up with foreign exchange. Okay, start. So we are talking about, okay, we are talking about exchange rate determination. So I want to tell you something is that when I say rupee per dollar, there has to be something which affects the value. There has to be some variable which affects or maybe values. What I feel, guys, okay, so when I say currency pair, rupee per dollar rate, for example, all the microeconomic variables in the social, economic, political, and financial environment will affect the rupee per dollar rate. Okay, I personally feel that you cannot even identify all of them. We do not know maybe all of them. So whatever we know, what can affect rupee per dollar rate, like GDP growth rate of two countries, inflation rate of two countries, and interest rate of two countries, then kind of what else, political stability of two countries, balance of payment of two countries, and so on so forth. So these are the factors which are going to affect the rupee per dollar behavior actually. Obviously the country which is otherwise stronger, the US has been relatively, see when you say strong and weak, it is relative, it is not absolute. I hope you get this point. When I say rupee dollar is strong, I am saying dollar is strong with respect to rupee. Okay, I am not saying dollar is absolutely strong possibly. So that way. So depending on these factors, rupee per dollar rate would be there. Since US as a country is stronger, or yeah, even today it's stronger. Okay, so we'll catch up fast in 5-7 years maybe, but yeah, it is obviously stronger by all ways and means. It is a very developed country. Okay, so if you go to that country, they have got so much of land. You can just cannot imagine what kind of land they have. Okay, and the number of people they have is very less. So they are able to develop because the per capita income is very high. Because with this amount of money, suppose, okay, they have very less people to feed. Okay, but in Asian countries like India and Pakistan and China and everybody, okay, the people are too many actually. So you will, if you I'm deviating a bit, if you go to New York and if you go to like New Jersey maybe, so New York to New Jersey, they are almost like a few kilometers away, but you will see a whole jungle in between, nothing. Okay, even the houses are like 1 kilometers to 2 kilometers away from each other. So they have so much of land. Okay, so that is one of the reasons. It is infrastructure wise, it is very, very developed. Okay, but we are catching up. Definitely, we have high hopes with our people, our government, and everything. So coming back, so is it possible to like calculate the impact of all the factors at one point of time? No. If I tell you, okay, let's take an example. So suppose rupee per dollar is a rate. Is it possible that I consider all the factors at one point of time and try to predict that should be the rupee per dollar rate? No, you cannot. You just cannot do that. So at one point of time, we will consider only one factor and keep all others as constant. For example, if I'm saying that India and US, suppose interest rate is one of the factors that can affect the exchange rate between rupee and dollar. So I can only consider one factor, that is interest rate of India, interest of US, and then try to predict on the basis of I rupees and I dollar, what should be the rupee per dollar rate. I will have to keep other factors like inflation rate, GDP and all that blah, blah, blah to be constant actually. I hope you understand that part. Oh, wow. So exchange rate determination. Okay. So on the basis of that, okay, the relationship between two currencies, okay, give me a second. So the relationship between two currencies based on interest rate is called interest rate parity theory. The relationship between two currencies based on inflation rate is called purchasing power parity theory. And the relationship between interest and inflation rate is called international Fisher effect. What I feel is that it is a high probability that they will ask you international Fisher effect only in theory. But yeah, I can frame a question also on that. Who can stop me doing that? But we have not gotten any question till today in the practical part for that matter. But I can do definitely. Okay, so I'll discuss all of them. So what is interest rate parity theory? Guys, I want to give an example actually. Once you've done that example, I think, so the first thing that you should know, what is IRP? Okay, what is IRP? What is the equation of IRP? Have I not given there? I'm just thinking that did I not give the formula and all? Okay, I need to teach that separately on the sheet. Okay. The first one is, what is IRP? I'll share this sheet also with you. Don't have to bother. What is IRP? The first thing. Instead of explaining you like in terms of sentences, why not give an example and finish it off? So suppose spot rupee per dollar is equal to 80. Okay. And I rupees is suppose 10%. And I dollar is equal to suppose 4% possible. So always remember one thing very, very important, that whenever, so what are you doing? What are you trying to do here? You are trying to find out the should be value of dollar in terms of rupees, correct? You are trying to find out the should be value of dollar in terms of rupees. That means you are trying to value dollar in terms of rupees. So every chapter that you have been studying till today, for example, equity, what are you trying to do? You are trying to find out the should be value. Then you are studying bonds. What are you trying to do? You are trying to find out the should be value of the bond. Okay, in foreign currencies, exchange rate determination, you are trying to find out the should be value of the Y currency in terms of rupees. When you do derivatives, we would be trying to compute the should be value of options, should be value of futures, okay, and valuation of a swap. Then when you study mergers, what should be the value of the merged company? So everywhere across the subject, what you are trying to do is to compute the should be value of the asset that is under contemplation actually. That is the job that we are going to do, because while committing anything, buy or sell with respect to any asset, you should know that whether this asset is undervalued relatively or overvalued. And in order to know that, we need to compute the should be value. I hope all of you are fine. Okay, it is very, very important for that matter. Okay, now, so I am saying I am trying to compute the should be value of the dollar in terms of rupees based on interest rate. Okay, so the valuation theory says that for any asset, not only foreign exchange, any theory says that the value, for example, yesterday's lecture I was saying that if BSE has, there is one stock whose price is 1000 on BSE and 800 on NSE, correct? I said that, okay? So none of the prices are proper, neither 1000 is good nor 900 is good. Why? Because arbitrage is possible. So in order to avoid arbitrage, the prices on both the exchange should be same. I'm sure you get it, okay? So the theory of valuation says that the price of any asset would be considered as fair when there is no arbitrage possible. That is the correct price of the asset. Some while I was conducting that Hindi batch of Fast Track, then someone asked me that, ma'am, arbitrage is good. Why are you trying to stop it? I'm not trying to stop it. But in order to conduct, arbitrages are good for the market, because I tell you, an asset becomes liquid only when there are arbitrageurs and speculators. Because like people like me, I buy a stock and forget for years. Okay, I don't go to the market again in order to sell that stock. But arbitrageurs and speculators are the people who create a lot of volumes in the market. Creating volumes means buying and selling. So you want to buy a stock. A stock can be called liquid when there are too many people standing to sell at different prices. Suppose you want to sell the stock, then there should be a lot of people standing to buy that stock, okay? Then you can consider the stock to be liquid or asset to be liquid. Suppose you bought and when you want to sell, there is no buyer, okay? That asset cannot be considered as liquid. So arbitrageurs and speculators have to create a lot of volume, because see, 900 1000 are it's a big gap actually. In practical life, it doesn't happen like that. The gap will be of like 30-40 rupees or 20 rupees or something. And I'm not considering the transaction cost also, like the brokerages, the commission, the STT and the taxes and everything. So if you consider that, maybe you would not be left out with any arbitrage profit for that matter, correct? So arbitrages create a lot of volumes in the market that helps the market to remain liquid actually. So what I'm trying to tell you is that, but I am wanting, see, it is a process. So the market will come, arbitrageurs bring the market back to equilibrium actually. Because if 1000 and 900 are the prices prevailing on the two indexes, okay, then what will happen? A lot of people would be selling and at one, and a lot of people would be buying from the another. So people who are the place where a lot of sell is happening, there would be a lot of supply, the prices will come down. And the place where there is a lot of buying happening, in that case, the demand will increase, the price will increase. So somewhere, for example, both of them will settle down around 950. Okay. So what we are trying to do, that we are trying to find out what should be the, suppose, I'm asking you that, suppose you have rupee per dollar spot rate 80. You have interest rate of India 10%, you have interest rate of dollar 4%. Then what should be the 1 year forward rate at which no arbitrage is possible? Okay, when I say that, I also mean to say, what do you mean by arbitrage in this case? A US person borrowing in dollar and investing in India, Okay, an Indian person borrowing in India and investing in US. Always remember the language that will come in the question will be US investor, Indian investor. Okay, so please tie a loop in your head that when they say US investor, it has to be compulsorily borrowing in dollar and investing in rupee. If you want to take a logic out of that, we can also say that, see, practically it is impossible. I don't say that, but then the credibility will be a big concern. In India, I have a lot of credibility. I can borrow, any bank will give me money. But borrowing from outside India would be a bit of difficult. Even if I have a triple rated company in India, it will be difficult for me to borrow in US because I don't have any credit rating standing there. Okay, that way. So it is a theory. IRP is a theory. So please hold on. Whenever they say borrowing in dollar, it has, sorry, US investor, it has to be borrowing in dollar, investing in rupee. When they say Indian investor, it has to be borrowing in rupees and investing in dollar. That's how it works actually. Okay, then can we go ahead now here? So if I solve this, suppose A for US investor, okay, borrow $10,000 at the rate of 4% per annum for 1 year. 10,000 into 4%, that will give me $10,400. B, convert. This amount is something I have to pay after 1 year only. So you will not convert this, you will convert $10,000. Convert $10,000 on the spot at the rate of rupees 80 per dollar. So basically how much are you going to get? 8 lakhs I feel, rupees 8 lakhs, right? You can multiply, you can very much see there, you don't have to bother about that. Invest rupees 8 lakhs at the rate of 10% per annum for 1 year. Okay, this is rupees 8 lakhs or 8,80,000. Can I write like that? I'm sure you will be able to manage that. D, I have not given you any rate to take the money back actually. If he is a US investor, his job is done, he would want to go back now. So what should he do now here? I am giving you 3 rates here. 3 rates as I always do. Okay, one is rupees 75 per dollar. One would be, yes Harsha, what should be the rate? Yes, always. When I say Indian investor, you have to come in the question compulsorily you will borrow in rupees and invest in dollar. Don't see, control on the subject is about, you know, this cannot be done. Okay, not what can be done, this cannot be done. For example, if I say Indian investor in the question of IRP, okay, you cannot borrow in dollar, and Indian cannot borrow. It's not allowed in the theory only. There are some assumptions there. Yes Harsha, can you tell me what is the rate at which no arbitrage is possible? Harsha is not there? Okay, I'll calculate. So basically guys, this rate has to be, Viru, can you give me the answer please? Anybody can give me the answer? How come? They will mention months, I don't have to, don't worry about that. Okay, not a problem. So can I not do 5.77%? Okay, so the rate would be 80 plus 5.77%. That gives me rupees 84.616 per dollar. I will tell you from where did I get this. And rupees, okay, rupees 87 per dollar. Okay, I've given you 3 rates. So now if you divide 8,80,000 divided by 75, I get operate your calci please. So 8,80,000 is his final inflow at the end of the year, right, after investment. So if the rate after 1 year is 75, okay, then divide by 75 naturally, you get 11733. How much you have to return? You have to return 10,400. Aren't you being able to minus 10,400? I get a lot of money, actually a lot of money I could generate, okay, because this rate is not proper as per arbitrage. This rate is not proper. This is not the rate. That means what should be the rate? You know what is the logic here? The logic is that the US investor is thinking that, see, there is a gap between India and US interest rates. Why should I not borrow at 4 and invest at 10, thereby generating a gap of 6% for myself? That is called arbitrage profit. So what should be the movement in the rupee per dollar rate after 1 year, so that whatever is the gap is lost on the exchange and is left only with 10,400. Okay, so if the rate is 75, there is a lot of arbitrage profit because he has to repay only 10,400 and is being able to look at that. 8,80,000 divided by 75 will give you 11733 minus 10,400 will give you 1,333.33 you will get, right? That means a lot. That means 75 is not the correct rate because arbitrage is possible for the US investor. Now same 8,80,000 divided by 84.616, you get exactly 10,400. Yes or no? You get exactly 10,400. Yes or no, guys? Correct. But this shouldn't happen. But correct, Harsha. So this should not happen. It should be like the rate. The perfect rate is this one actually. Yes, perfect rate. And if you use 87, then 8,80,000 divided by 87, 10,114.94. That means at this arbitrage, at this rate, so both of them are not correct because I tell you something. If I've given you 3 rates, okay, at 75 arbitrage would be available to the US investor. You know something? At 87 arbitrage would be available to the Indian investor. So there should be no arbitrage to either one of them for that matter. So the perfect rate is 84.616. Correct. So 84.616 is the proper fair value of rupee and dollar after 1 year. How do you interpret this? So if today's spot rate is 80, if Indian rupee interest rate is 10% and US dollar interest rate is 4%, then if the rate is 84.616 after 1 year, then there will be no arbitrage. Any rate other than 84.616 like 75. At 75, arbitrage is available to the US investor. At 87, if you try to cross check, arbitrage would be available to the Indian investor. So 84.616. So what is the decision making here? The decision making is that if you have two countries like India and US, if you have two countries like India and US, India having an interest rate of 10% and US having an interest rate of 4%, then the country having the lower interest rate should trade at a forward premium in order to avoid arbitrage. What am I saying? I am saying that if India's interest rate is 10% and US interest rate is 4%, then the country having the lower interest rate, in this case what? US has got the lower interest rate. The dollar should trade at a forward premium after 1 year. Trading at premium means, suppose today's rate is 80, then the value after 1 year should be more than 80. But you need to quantify that. How much more than 80? So it says that it should be to the extent of interest rate differential. That means 10 minus 4, 6% approximately and 5.77% exactly. That means to say the differential between the two interest rate and the differential between the spot and forward should be the same in order to avoid arbitrage. Are you fine, guys, all of you? Correct now, all of you? So basically IRP means the differential between the spot and forward. Can I write something of this sort? F minus S by S is equal to 1 plus IA minus 1 plus IB the whole 1 plus IB. Okay. So basically A here stands for X currency and B stands for Y currency. Okay. This is the equation. Okay, this is the equation. That means the different percentage change between the spot and forward, and the percentage change between the two interests should be the same in order to avoid arbitrage. So many questions of ICI you would see that they are computing differentials between the two. They compute differential between F and S, and they also compute differential between the two interest rate, and then they compare. So if they are not same, they would say that okay, arbitrage is possible. Okay, that way. I'm sure guys all of you are comfortable here. Now before I move it, I should be sorting out one more point here. So now number 2, equation of IRP. Equation of IRP. So the equation of IRP guys is a F by S is equal to 1 plus NIA by 1 plus NIB. What do you mean by that? So basically this equation is nothing different as such. If you add 1 plus here and plus 1 here, and if you solve this, you will get the same equation, this one. So I don't want you to mug up the formulas, not required. One thing. Another thing is that when I wrote this equation, this one, then I assumed 1 year time frame actually, and that is why I'm taking IA and IB. There is no time factor adjustment here. But in the sums that you would get, okay, so don't you think that if you are having if you want to calculate a forward rate of like 3 months, you cannot take interest rates of per annum, so you need to provide time adjustment like this N and N. So when do you use this formula? When the rates are, can anybody tell me what is a minimum compounding period? What do you mean by compounding? When the interest rate is added to your principal, that is called compounding of interest. Correct? No? When the interest rate is added to your principal, it is called compounding of interest. Right? No? Now, minimum compounding period would always be 1 year. That means to say, even if I do not redeem my investment, I am going to calculate at the end of 1 year that how much return I have earned. That means the minimum compounding is 1 year. The compounding can be more than 1 year, one time. Okay, it can be quarterly, it can be half yearly, something like that, or it can be daily also. So when the rates are compounded, okay, annually, like how do they mention? Per annum annualized, nothing else. Okay, then the another formula is F by S is equal to 1 plus IA raised to the power n and 1 plus IB raised to the power n. When the rates are, so when the rates are compounded more than once. Okay, and the third formula C is F is equal to S into E, IA minus IB and into N. This will not create a problem for you at all. Give me a second. This will not create a problem for you because any which ways your calci cannot calculate IA minus IB. Okay, this will also not create a problem for you because it is easy to understand. You might face some issues with respect to this. So I can only tell you that, not getting into too much of detailing at this point of time, I can help you on that. Is that, suppose I give you an example. Example is a spot is suppose like rupees 85 per dollar. I'm predicting the rates as if. So I rupees is equal to 10%. Okay, that means it is IA. Please give messages to your brain properly. I dollar is 4% per annum. It is IB. Okay. Now I'm asking to calculate a forward. Compute 6-month forward. So F by S 1 plus NIA by 1 plus. Did I say anything about the compounding? Nothing. That means the first formula. So F is equal to 85. Quickly guys. So 1 plus 6 by 12 into 0.10. Careful. Divided by 1 plus 6 by 12 into 0.04. Be careful about this because people end up writing 0.4 here. That could be a big mistake on your part. Okay. Then again. So how to solve this? So basically half, right? So 1.05 divided by 1.02, the whole into 85 gives me 87.50. So 6 month forward will be equal to rupees 87.50 per dollar, and we are done here, right? But in the second case, suppose I use the same example here again, okay, again example, and I write here rupees $80, rupees 80 per dollar is your spot, okay, and I get I rupees is 10.25% per annum, okay, then I dollar is equal to 4.04% per annum. The rates are annualized effective. The rates are annualized effective compounded semi-annually. So how do you solve that? You cannot use the first formula here. You know why? Because there has been okay, compute 6 month forward. Okay, you cannot use the first formula here. It's not allowed. Okay, why? I tell you. If you start with 1 on January 1, okay, at the end of on 30th of June, you will add 5%. The money becomes 1.05. Okay, and then again when you add 5%, the money will become 1.1025. That means compounding is happening 2 times. Same for dollar also. But if you are planning to exit at the end of 6 months only, would you get that extra 0.25? Are you going to get half of this 0.25 because it is compounded? No, you will not get. In order to get this extra 0.25, you need to be in the system for the whole year. If you are exiting at the end of 6 months, you will get 1.05 only. But if I use first formula for this, what will happen? I will take 1 plus 0.1025 into 6 by 12. That means you are taking half of this 25 also, and that is wrong. So how do you do that? So F is equal to 80 is equal to 1 plus 0.1025 divided by 1.0404, okay, rest to the power 1 by 2, 6 by 12. I hardly see this kind of sums being asked, but then why to take a chance at all? So if you solve this, guys, you'll get 80 into 1.05 and 1.02. That means even if the rates are compounded semi-annually, you won't get half of that extra compounding thing because you are exiting at the end of 6 months. Could you get that, all of you guys? And hence the answer would be same, 87.50. And we are done on this part also. So quickly moving on to the next question actually. So the question that we have to do here is like this one. Okay, ready all of you? So question number 6 on that basis. Based on 6 month forward rate of 42.60, the forward discount on dollar, okay, the forward discount on dollar happens to be 10%. Find the spot rate, correct? So they were given you guys 6 months. Be careful, all of you. Did you understand this part, all of you? Guys, you need to respond, then I move ahead. So the upcoming questions are a combination of 2 things. Number 1, premium or discount on dollar, and plus the IRP formula. So if you remember at all from the last lecture, in order to compute the premium and the discount, you get it, right? So from the last lecture, guys, you studied what? Computing premium and discount on Y currency and X currency also. Just close your eyes and tell me how many variables do you want in order, how many variables are there in the whole equation of premium? One is premium, one is F, one is S, okay, and one is N. Agree? 4 variables are there. Yes or no? previous solution. Okay, this one you are saying. The calculation is wrong, this one. Just it could be a computing error, nothing else. The logic is not wrong anywhere. Okay, so 1.05. Okay, 1.05, that is okay, that is okay. I am more focusing on the logic. There could be some error in the calculation. Divide by 1.02, okay, and into, what's the rate? 85. Yeah, 85. I get 87.50 only. Yeah, or can I calculate like this? 1.05 numerator into 85, the whole divided by 1.02. Am I wrong doing that? 87.5 only. Acha, this one. Okay, sorry. Okay, sorry, my bad. Why? I assumed that I have taken the same spot. That's completely a blunder. I thought the spot that I took here and the spot I took is same. No, it is different. So let me change the answer. Yes. Not a problem. Got it. In my mind, they are same actually. That is why. Okay, so 80 into 1.05 divided by 1.02 will give me 82.35. Yes. Thank you, Harsha. 82.35 is the rate. Yes, I got it. I just missed out on that. Okay, fine. So let's do one sum here. My question to you was a different question. My question to you was that there are questions where you would see a combination of premium on Y, premium on X, that calculation that you did in the last lecture, and the IRP formula. So if you see that the data required for both the calculations are very similar, okay. What data? So if I say premium on Y, premium on dollar against X, okay, how many variables would be there in the equation? Premium on Y, F, S and N, maturity, 4 variables, okay. And in the IRP formula, you have F, S, N, 3 are common already there, and IA and IB, I rupee and I dollar. So they might frame a question wherein you need to solve something for IRP formula. For example, I want to calculate I rupees. They would, and you, for that you need F, S and IB or I dollar, correct? If there are 4 variables and you need 3 to solve, okay. So what they will do, they will not give you 2 variables. Okay, maybe they would not give you F, they would not give you I rupees. You cannot solve for 2 unknown variables from one formula. So, but they will give you some information about the premium data. So you will first set the equation for that premium on Y, F minus S and so on, solve for that one unknown variable and get that data to IRP formula. So question number 6 I have given from my side. 7 is an institute question for that matter. Okay, start here. Based on 6-month forward rate, okay, 42.60, the annualized forward discount on dollar, okay, that means the rate given to you is rupee per dollar, okay. So on dollar means F minus S formula has to be there, right? But when they are saying discount, this 10, we know formula only for premium, right? We do not know any formula for discount. So what will you do? You will give a minus to this, because we do not know any formula for discount, okay, but we know for premium. But when they say discount, it has to be minus 10. I hope you agree on that part. And I set the equation here. 42 point, since it is on dollar, the formula will be F minus S, okay, and hence we get spot rate here. It's a very simple question actually, maybe like very straightforward question. There was nothing in the question. It's a very easy question for the matter. This is not even an IRP question. Why? I don't know why have I put this question here. because this should be somewhere somewhere else actually. So the proper question in this category is this one. Should we start solving this? We should start solving this. Yes? Yeah. So guys, here if you see the sum properly, I would rather want to, you know what I'll do? I will rather cut this maybe like this. Okay. And I will copy there, where, so that I can solve properly. Otherwise I'll have to like look for the data again and again. Okay. Okay, start now. The following table shows interest rate for the United States and dollar and French francs. The spot exchange rate is 7.0. You need to solve this question, guys. 7.05 francs per dollar. So 7.05 francs is sum and per dollar is 1. So can I write here spot, okay, FFR 7.05 per dollar, correct? So guys, you know, can I call all of them as like A, then B, then C, then D, then E, correct? No, I can call like that. And maybe like, are they asking to calculate this one also? I don't know, I'm not sure. So first let us start solving for A. And can I call this as A, maybe 1, 2, 3, that's a better thing. 1, 2, 3. Now 2 questions in 1, 2 questions in 2. So 1A. So the data given to you is that interest, can you see here guys? So the data is spot is already given to you. Can I write again for this part only? It will give you some message to your brain. 7.05 per dollar. Okay, then you have, this is A. This is your IA and this is your IB if you are like comfortable. This is your X and this is your Y. I'm sure you are comfortable on that part. So now, what is the interest rate here? If I see here, interest rate compounded annually for whom? Dollar I fill. Franc interest rate is 19.5% per annum, annual compounding. Okay. So IFFR is 19.5% per annum and this is actually IA. And I dollar is how much? It is actually 11.5%. So 11.5% per annum and this is actually IB. What am I supposed to solve here? They are asking to calculate forward franc per dollar, okay, and forward discount per franc percent per year. Very, very important language here. What are they giving you? Forward discount per franc. Forward discount per franc. Can anybody answer here that forward discount per franc means what? As per the quotation, FFR is X and dollar is Y. That is what I can understand. So when they say forward discount per franc, are they asking F minus S or S minus F? Please tell me. They are asking for see, we do not know any formula for discount. I can only calculate for premium. If it is negative, it is called discount, correct? No? But it is important for me to understand that whether I have to set an equation on Y or on X. Very good. How did you understand that? Careful. How did you get that? So basically, if you see per franc, that means they're asking on franc basically. On X. Very good. Then I don't need to explain you too much. Let's go ahead quickly. So can I write here annualized premium on FFR so 7.0. Wait a minute please, it's goofed up a bit, I feel. So you have, yeah, I goofed up, yeah, Why I tell you, in this question you will have to first calculate forward rate as per the IRP, and that forward rate can be used to calculate the premium on FFR. Agree all of you? Because I have two rates, I already have two rates and I have a spot rate. So using all these three data, I can compute the forward rate as per IRP. So just leave it like this only, just leave it. We'll come back to this place again. So as per IRP, that's okay. As per IRP, okay, so F by S is equal to 1 plus NIA by 1 plus NIB. So we need to calculate this actually. 7.05 into 1 plus 0.19, please check on the rates if I'm going wrong or something like that, into 3 by 12 and the whole divided by, okay, 1 plus 0.115 into 3 by 12. So it doesn't matter. I told, while teaching also I told you that these two formulas are often combined to solve data. So in this question, usually whatever sums we have done in the class also, in every sum we first try to compute S or F from the premium formula and substitute in the IRP formula. But here in this question they've given data for IRP and you have to solve for premium, which is okay completely. Yes, no? Okay. So can I write again 7.05 into 0.195 into 3 divided by 12 plus 1, I get 1.04875 and the whole divided by 0.115 into 6, 0.195 into 3 divided by 12 plus 1, 1.048, that is correct. Then 0.115 into 3 divided by 12 plus 1 will give me 1.02875. Now we can solve it. So 7.05 into 1.04875 divided by 1. Harsha has taken the driver seat, 7.19 per dollar. So 3 month forward will be FFR 7.19 per dollar and we are done here. So now B. So again here, so 7.05 minus 7.19 by 7.19 into 100 into 12 divided by 3. So the answer would be 7.05 minus 7.19, okay, divided by 7.19 into 100 into 4, I get 7 minus, but the answer they have given is not the same. This answer does not match with the ICI answer at all because they have taken a different way of solving. Do you want me to help you on that, or you will be able to identify that? Please tell me quickly. This answer, look at the solution. This answer does not match with the ICI solution. There is a logic to it. Do you want me to do quickly that part also? Do you want me to do that part quickly, please? Because it is the answer will not match. Rest of all the answers are matching. This answer does not match for ICI. Ours is not wrong at all. It is not at all wrong. Don't even think that it is wrong. But the method, depending on the method, there would be some rounding off errors and everything. So how does ICI solve? So they have solved spot dollar per FFR will be 1 by 7.05. That gives me 1. So 1 divided by 7.05 will give me 0.142. And what they have done, you know, so they have done like this. 1 year forward dollar FFR rate. Please see, I'll take only 1 minute extra to do that. Your effort will be, I don't know, Viru, I really don't know. You know it is not wrong. You are not a kid. You understand, you know, kind of that this is not wrong at all. But I don't know. I mean, if they ask a question, I can just help you to understand their solution. Mostly they will cancel the marks there. Maybe it is see, they are not all of them are not interlinked, and that is why I feel that they might cancel some marks in the step marking, possibly. So 1 year forward calculation, how do they do that? So look at this. So F will be equal to 0.142 is equal to, now do you understand one thing, that in the formula, guys, in the formula, this is your A and this is your B. So this will be 1 0.115 and 1.195 like this, okay, and they have computed the forward rate. How would you do that? 1.115 into 0.142 divided by 1.195, I get 0.132. 1 year dollar FFR is 0.132. So basically what they have done, I tell you the logic. They already have the spot rate, okay, they already have the spot rate, and they calculated 1 year forward rate, okay, using the equations, and then they take a difference. So premium on FFR or premium per FFR, that is how they have written, no? So premium per FFR, your calculation is not wrong. So will be F minus S by S into 100. Why? The rates are already 1 year, because I calculate, there is no time adjustment here if you see. So this will be 0.132 minus 0.142 and then 0.142 into 100. So you will get exactly their answer. 0.132 minus 0.142 divided by 0.142 into 100. That you will get. Are we getting minus 7.04% there in the institute answer? Please tell me quickly. Are they getting minus 7.04%? I'm not sure. I have not seen the answer. But what I remember, it is not the same. They have done like this. That's what I remember. Please tell me whether we are going correct or not. Okay, so next one. So I know they have done the same thing actually. So 2. Again, spot FFR per dollar is 7.05. Okay, now what is the data? What is the data? The data is 12.25 for 6 months. Okay, look at, be very careful. They've given the interest rate for FFR. You have to calculate interest rate for, no, they have given the interest rate for dollar. You have to calculate for franc, okay, and you have to also calculate the forward. But they have given there's again some mistake here. If you see, forward discount per franc percent per year. That means this is discount on this thing FFR, okay. So when profit is minus, when you get a profit is equal to minus, you call it a loss, okay. Have you ever done loss equal to minus and then you call it a profit? We never do that. So this is, if you see forward, the word is discount, okay, the word discount. So when it is a discount word here, it shouldn't be minus 6.3, it should be 6.3, okay. The previous S minus F is not wrong at all. So we are taking S minus F because we are doing with FFR per dollar. That is why it is S minus F by F, because you want premium on French franc. So if French franc is on the left hand side, the formula has to be S minus F. And if French franc is on the right hand side, the formula has to be F minus S. That control is more important. So quickly, 12.25 and 6.3. Okay. So here, please can you write some data for me? I dollar is how much? And annualized premium on FFR is if you want to write minus, then the word has to be premium here. You cannot write discount and then write minus 6.3. It is wrong. Okay, so this is 12.25%. Okay, now, so what should I do? First of all, I think I should go ahead with annualized premium on FFR will be S minus F, because here in the quotation it is on the left hand side. That is why I need to take S minus F only. F into 100 into 12 divided by 6. Be careful here now. So some updates are not good. So this was not this black thing. Okay, it looks like a black, kind of a big thing there. So somehow I don't like it. So minus 6.30 is equal to S is 7.05 minus F by F into 100 into 12 divided by 6. Solve it. So minus 6.3, okay, into 6 divided by 1200. Okay, I get minus 0.0315 plus 1. Okay, and 6.3, no, 7.05. What will be the answer? Tell me now quickly. Minus 6.3 into 100. What am I doing? Minus 6.3 into 6 divided by 1200. Okay, and plus 1 will give you 0.9685. Okay, 0.9685. So 7.05 divided by 0.9685. That's what I can do. I get 7.28. 7.28 is the answer. So 6 months forward, will FFR, is the answer correct as per ICI? Can you please tell me? I think it should be correct. This was A part. No, not A part. This was C part, I feel. C. Then now D. As per IRP. Okay, can I write 7.28 by 7.05? What have they given? 1 plus 6 by 12. What is the data given to you? I dollar. Okay, and that rate is 12.25. Fine. Into I FFR divided by 1 plus 6 by 12 into 0.1225. Okay, solve and you will get the answer. So maybe I can solve like this. 0.1225 into 6 divided by 12 plus 1. Okay, into 7.28 divided by 7.05 minus 1 into 12 divided by 6 into 100 will give you 19.17%. So IFFR is equal to 19.17% per annum. Okay. Can you carry the question forward ahead on your own now? Should I leave this? Because we can move ahead, guys, in the next question. Are you fine what I'm saying? I think you have gotten a control on the question now. Can I move ahead to the next topic? Because it is important to cover a lot of topics before I wind up for Forex. Maybe like tomorrow only. But if we could save more time, it will be great. What do you say? Quickly. What happened to all of you? Today you're not interacting. Yesterday you were too much excited actually, all of you. We can continue. Yes, you can do on your own. Nothing is left in the question now. Now this is done. This is done. We need to move very fast now because there is a lot of portion pending. So it is important that we should reach somewhere, guys, today. So what should be the target? I tell you something. IRP, PPP, all should be over today only. And then we can do a few more things here. Long-term investment. Then, after this exchange rate thing is over, now you will not take too much of time. It will be very easy for us. But till the time this IRP, PPP thing is, kind of there, we will not be able to move ahead too easily, actually, to be very precise. So we need to finish that part at least very, very quickly. Okay, so this is done. Now, rationale of IRP, quickly. So what is you already know this topic. Rationale of IRP, you already know this topic. I tell you why. Because, see, they will give you 4 data sets. Careful, they'll give you 4 data sets: S, F, IA and IB. Okay. How did I solve for IRP? I solved for IRP by taking 4 steps. Okay, borrow in dollar, convert on the spot, invest in India, bring the money back. If you have gotten money which is greater than the amount with which you started, then arbitrage has happened. Okay. So let me tell you 2 things here. Number 1, if it is rupee and dollar, arbitrage can be tried out by 2 people, either by a US investor or by an Indian investor. Always remember that if US investor is getting a profit, Indian cannot have. It is not possible to have. If Indian is getting profit, US investor cannot have. Okay, number 1. Number 2, In order to IRP to hold good as per the theory, you cannot have two set of rates like bid and ask. Okay. So when I say this, it is not possible for a US investor to earn arbitrage profit if Indian is earning money. Okay, it is not possible to have. This sentence of mine, this comment of mine, okay, will only hold true when there are no transaction costs like brokerage commission and bid ask spreads, because bid ask rates are transaction cost for a person actually, because you are buying at a higher rate and selling at a lower rate. Okay, so if you get a question of, so one method is that they give you a question, okay, like this: check for IRP and carry out covered interest arbitrage using 1000 or 42,000. That means to say you will do the sum from both the sides. Obviously you also know that if you get positive answer for Indian, you won't get positive answer for US, but since they are asking you to do from both the sides, you are going to do. S minus F, it is simple, no? So on Y, F minus S by S, and on X is equal to 1 by F minus 1 by S by 1 by S, because you need to compute this for this thing, right? Sorry, for this thing. So if you solve this, no, sorry, if you solve this, you get S minus F, Mansa. Okay, now quickly going ahead now. So basically, yeah, so one way is that I could take only one question in this category because we will not be able to cover the portion otherwise. So here I will tell you all the ways adjustment possible. Okay, so either this question can be done like a layman, that means you first borrow in dollar, convert on the spot, invest in rupee, and take the money back to US. Okay, then you can borrow in rupee, okay, and then you convert the rupee into dollar on the spot, then take the money to US, invest the money there, and bring the money back. Okay, as I told you that one will have profit, one will have for one arbitrage is possible, for the another one the arbitrage will not be possible, but you do not know for whom it will be possible, so we do the sum twice. So if you get, for the first time you start for the Indian investor, it is very natural to start the sum for the Indian investor because we are Indians. It's a comfortable thing actually, and you get profit. Then don't do the sum again for the US investor, because you can write down as a conclusion that since Indian is getting arbitrage profit, the US citizen will not get. But if you do for Indian, you get a loss there. Okay, then you can say arbitrage is not possible for an Indian, but we need to try out for the US citizen. So definitely you are going to get a profit. So that way. But there is another way of solving this. The another way is that you check for IRP. Why not we check for IRP? So we see that there are 4 items here. One is F, one is S, one is IA, and one is IB. So what we can do, guys, that you can, like in an equation, F by S 1 plus NIA by 1 plus NIB. What you can do, you can keep one of them, any one of these 4 as silent, and solve for the unknown variable, and then compare that should be. Okay, suppose for example I keep this as silent, F silent, that what should be the rate, forward rate, okay, in order to have no arbitrage situation, and then I compare this should be forward rate with the actual forward given. Okay, so some rules have to be followed. Some rules have to be followed here. So what are the rules that you need to follow? I'll write them quickly here, maybe, right? Okay, arbitrage rules. So basically arbitrage rule is, if actual IA is less than should be IA, I'll tell you the logic, should be IA. Okay, if actual spot is less than should be spot, if actual IB is greater than should be IB, okay, and if actual forward is greater than should be forward, then arbitrage would be available to country A. So you can keep silent any one of them. You can keep silent any one of them and solve, okay, and compare with the actual given. So if either one of them holds true, arbitrage will happen for IA here is rupees, okay, for rupees. If it is not true, do for the Y currency. I think we are sorted there, guys. Yes. So look at this here. So F by S, if you see this question, what did I do? I kept IA as silent, though IA is given as 12%. And then I solve, I get 13.78%. So should be IA 13.78, okay, but actual IA is 12%. So the actual is lower than the should be. So if the rate should have been 13.78, the rate is 12% here. I will definitely borrow. We should borrow in rupees because the rupee interest rate is lower than what it should be. Okay, so if rupee is undervalued, dollar rate is relatively overvalued. Even if you do not want to speak all this, what is the point? No, do not put your head only. I give you the rules. When actual IA is less than should be IA, to whom the arbitrage is available? People of country A. Means borrow in rupees, invest in dollar. And we are sorted, guys. These are the 4 steps of that we have to take. So borrow in rupees 42,000. Okay, after 3 months you pay 43. I already did when I was teaching what is IRP. Okay, so convert 42,000 on the spot, you get $1,000. Invest $1,000 at the rate of 7%, you get this amount, and again convert. You will get arbitrage profit of 187.25. You can do it, guys. You can do it on your own because the same steps I took while I was explaining what is IRP. Same. It is no different at all. Okay. So basically there are 2 ways. Do for both of them. Once for Indian, one for US. You know what will happen. Or keep one as silent. Compute the should be value. Compare with the actual. Comparison rules are given and then go ahead. And we can also move ahead now. Forward cover versus money market cover. There are 10 people sitting out here. Can all of you tell me, is it comfortable till here? You need to answer, guys. Otherwise I don't understand. It becomes a monologue actually. Please tell me quickly. Okay, so let's go ahead with the this thing. So now we have applications of IRP, guys. Forward cover versus money market cover, short-term borrowing and investment, and long-term international project appraisal. 3 topics coming back to back. So once I've completed IRP, we can have a sigh of relief because IRP is very lengthy in the Forex. So once IRP is over, like as if 50% of the portion is over, we are okay. Thank you. Thank you, everybody. Now, an Indian firm has $1 lakh payable and 2 lakh pounds receivable. So there are 2 questions actually here. Okay, be very careful. So given a spot rate is given to you, 3 months swap points. So when you are an Indian, okay, and you have a payable of $1 lakh, you would definitely look for rupee per dollar rate. And when you are an Indian, you have a receivable of pound, you would look for a rupee per pound rate actually. So when I see the question carefully with a lot of mental peace, I see that rupee per dollar spot is available and I can calculate the forward rate. Okay, and because I need a forward rate because the payment and the receipt would be after 3 months. Okay, I can calculate, there's no problem. But then for rupee per pound, I will have to calculate cross currencies because rupee per pound direct quotation is not available here. Okay, so now first let us do for the payable and then we can talk about the receivable. Okay, so payable is forward cover versus money market cover. So look at, I'll go very, instead of explaining you the logic, I'll explain you the steps that will make you comfortable. Now, since I have a payable, I told you yesterday also that we need to buy what? Dollar. Can I buy dollar? Yes, I can buy dollar. Which rate? 43.80. But it is a spot rate. I cannot use a spot rate. And then they have given swap points are low, high, add. So 43.8 plus 0.3 will give you 44.10. Look at this. And $1 lakh multiplied with 44.10 gives me, that means if I buy a forward cover today, then after 3 months my payment will be 44,10,000 actually. Then money market cover, invest, buy, borrow. What is this? Suppose I give an example, after that you can see the solution. Suppose you are a person who are wanting to go to US after 3 months. Possible? Today is 1st Jan. You are planning to leave for US on 31st of March. At that point of time, you will require $1 lakh. Okay. So I think that why not invest some amount of dollars today so that that invested amount becomes $1 lakh after 3 months. My question to you is that you will invest $1 lakh or less? Please answer. We will not take too much of time now. This will be quick. Only the basics part takes a lot of effort on the teacher's part also, because I am building your base. Now you are comfortable. Less, yes. So look at this. So invest the present value of $1 lakh at the rate of 4% for 3 months. Okay. So this is the amount that you can invest, okay, in order to get $1 lakh after 3 months. Okay. Now I have a payable of $1 lakh after 3 months. I don't have money only. If I had money, I would have paid to my client. And all the more in India, where do I get dollars? I need to buy these dollars on the spot, because this money is now standing at T equal to 0. So this is the money that you would need to buy these dollars. I don't have rupees also, because only when my debtors give me money, I have maybe imported some garments. Okay, only when I'm able to sell my consignment, I get money at the end of March, then only I will have money. So all these calculations, right from 99,009.90 to 43,36332 is all happening on 0 period, right? So what will I do? I'll go to the bank, ask for this money. The bank will give me this money, and after 3 months I will pay the bank this amount. Basically this is the flow of the question. So actually, if you see, the question is moving opposite. How are the steps happening? You borrow rupees from the bank today. Okay, 0. We're standing at 0. Okay, we borrow rupees from the bank today. You sell those rupees and buy 99,009.90. Okay, and you go to the bank and deposit that money in the form of an FD. Okay, when that FD becomes mature after 3 months, that $1 lakh FD will be paid to the client, and you will pay to your bank this amount. So basically, but I do not know how much amount to borrow, and that is why the sum is moving opposite. That is the logic. Have you been able to understand this? So guys, you keep on telling me yes ma'am, no ma'am, so that I can move very fast. Then I will not be slow, because till the time you keep on interacting, I will not be able to understand, and I'll keep looking for your validations that whether they've been able to understand or not. Yes, I think it is easy, right? Only the sum is moving opposite. You are actually borrowing rupees, selling rupees, buying dollar, investing those dollars, and making it 1 lakh after 3 months. But I do not know how much to borrow, and that is why the sum is moving opposite. So now the same question, yes, for receivable. Receivable is relatively very easy, because you have like kind of, what do you say? It is like a bill discounting. You already have studied what is a bill discounting. So basically, kind of, I have sold something. I'm an exporter. I sold something and the money will come after 3 months. How do I run my business? Okay, so I have some shipping documents. Okay, when I export, I have shipping documents. I will take those. So the owner of the shipping documents is the one who will get money, correct? So I will take that shipping documents to the bank. I'll give those shipping documents to the bank. I'll tell him, okay, when 2 lakh pounds will come after 3 months, you can have that money. So please give me money in lieu of these documents. So naturally, the money that is going to come to the bank is after 3 months. And if you're asking for the money now, it will give you less. Okay. So they will cut the interest part, or slash out the interest part of 2 lakh pounds and give the money to you. Okay. Now, what will you do with the pounds? You'll sell in the market and use in your business. Look at this. But before moving ahead, you need to calculate what? The cross currency rupee per pound rate and cross currency spot and forward both. Because forward you need for the forward cover, spot you need for the money market cover. So look at this. Correct. Now, spot is given to you. Now 3-month rupee per dollar you calculated, then spot dollar per pound you calculated, spot is given to you, and forward. And then you calculate spot to spot, guys. This to this, and this to this. There should be a matching thing happening. Okay, like this. Okay, so we get for 3 months. Now the cross currency rate, rupee per dollar spot, can you not see that spot will be required, rupee per pound spot would be required for money market cover. Okay, so since it is a receivable, you're going to sell pounds, this rate would be applicable. Similarly, if you adjust rupee per dollar and dollar per pound in the forward market rates, you'll get this. Again, the rates applicable to us would be this one. Forward cover 2 lakh pounds into 91.486, you get this answer. In the money market cover, this will be the present value would be calculated. The bank will give you this amount today. When you provide with the shipping documents to the bank will be able to receive 2 lakh pounds from your client after 3 months. You go to the market, sell off this, and you get this amount of rupee, and you invest these rupees into the business again, and this is what you get. You will compare the answer of the forward and the money market. Here we see that money market cover is giving you a higher answer, and hence for payable we will go for forward cover, for receivable we'll go for money market cover. So we still have 2 hours left. We're going great actually, we can cover quite a lot of stuff. So just tell me when you get tired, it is okay. So guys, what I feel is that whatever you study with me, it should be like, okay, this portion of mine is done, and rest of the time you can invest in studying other subjects also. Okay, so it is okay that way. So don't take overloaded stuff, because fast tracks are tiring. For the teacher also it is very tiring, because you don't get a breather. For the students also it is very tiring, because they are taking too many concepts at one shot. It becomes very difficult. Like for the Hindi batch, we were doing only 2.5 hours daily, or maybe quarter to 3 hours daily. But then now we do not have that kind of time that we can go that slow. So at least 3.5 hours of lectures are required in order to complete the portion in time. You want a small break of 2 minutes? Yes. If you're wanting to have a break off, it's already around 10 o'clock. So tell me, what time do you want to have a break for breakfast? We can have a break of 10-15 minutes for breakfast. We are going quite good. So if you see here, I go by pages actually. There are 41 pages and we have done already 14 pages. So we should be going at least up to 25 or 27 pages, 28 pages maybe. Mansa is saying, I want payable part. You did not understand, Mansa? Fine. Payable part you did not understand. So imagine like this now, that you are wanting to go to the US after 3 months, okay, and you want $1 lakh at that point of time. So what you can you say that, okay, why not I invest so much of dollars today, which becomes $1 lakh after 3 months? You can think like that. Okay, but in order to invest, you need dollars. You are in India. You are in India, right? So you need, I compute how much dollars should I invest today so that they become $1 lakh after 3 months. Okay, so the first step. So basically we compute the PV. Now if you want to go by this strategy, you need to have dollars, and for that you need to have rupees also. Okay, there are two things here. Number one, I don't have rupees, I don't have money only. That means I don't have rupees and I don't have dollar also. Okay, first of all, I try to see how much rupees would be required. Let us arrange later on. Okay, so in order to invest that, how much rupee would be required? So when I convert at the spot rate, I get the value. Okay, now second question, I don't have rupees only, so I borrow from the bank. So what will happen after 3 months? You will pay to the bank in rupees and not in, so your fear of conversion is gone already. So you blocked that conversion at a 0 only. Now you are not going to convert. So that is the whole logic here. So maybe you revise and tell me. If you do not understand, I can explain you again. So short-term borrowing and investment, guys. Okay. Okay, short-term borrowing. So we did forward. Is it okay now? No, you cannot borrow. As per this, you cannot borrow in dollars, Mansa. Nobody will give you dollars because you do not have any credibility. You can only borrow rupees because you are in India. Okay. So you are going to you are not borrowing. Where are you borrowing in dollars? You are basically borrowing in rupees. Okay. Selling the rupees on the spot. Okay. You are borrowing in rupees, selling the rupees on the spot, buy dollar. You are borrowing rupees and using those borrowed rupees to buy dollar and create an FD. Okay, so two things will happen on maturity, that FD will mature and the payment would be done to the client. Okay, and on the other hand, whatever you borrowed from the bank, you will pay along with interest in rupees. Understood. Okay, so now short term borrowing and investment, be careful now. So basically there is a concept called kind of you always would have heard now that FIs are coming to India, they're investing, they're going back. So when they come, the Sensex rises like 1,000 points, 2,000 points, 4,000 points, and when they leave India, kind of, then the Sensex falls equally bad. Okay, so the concept is that, suppose there is an investor. Okay, I can use this question only. Suppose there is a US fund. Be careful. I'll use this question as an example actually. So a US fund brought $1 lakh into India at the beginning of the year. When the exchange rate was rupees 40 per dollar, he invested the corresponding rupee proceeds in the Nifty. So basically, when there is a US investor and he has got $1 lakh surplus, he wants to invest in India. So the first step he needs to do is to, yeah, I think we need a break. Even I need a break of 5 minutes, please. So why not take a break only, na? It's already like it is a run of 1.5 hour, a good run actually, a good run. I don't think it is a bad run because we are already at the 15th page. That is how we have to think, guys. And we have to go up to 40 pages. So 25 pages are pending. So even if we go up to 27, 28 pages, we are sorted for today. Okay, and then 10 pages can be done, or maybe 7, 8 pages can be done tomorrow, not a problem, because one shot you cannot take it also so much. So let's take a breakfast break. No, guys, is it okay? Why take breaks two times? So it is like, kind of, if I see my watch, it is already 9:56. So why not meet at 10:10? Let's meet at 10:10, possibly, or 10:15 maybe. Yes, we definitely, even I need, because constantly I'm speaking like 9. I have 9 hours of lecture on a daily basis. So I'm also getting a bit tired. So if the breaks are there, we can stretch more. Let's meet after maybe 10:15. Yes. Yes, yes, yes. 10:15 we are meeting. Okay. I was about to say that actually. So I'm ready. All of you are ready? Yeah. Okay. So shall we start, all of you? Okay. So here, guys, the concept that I was discussing with you is short-term borrowing and investment. Okay. So how does it work? Just try to understand. Yeah. So basically, this concept is related to a particular situation, as if, like, how do I tell you? The same example that I've given to you. Okay. A US person wants to come India and invest money for short term. When I say short term, it has to be 1 year only, not more than that, maybe lesser than that possibly. Okay, less, it can be less than 1 year, but it cannot be more than 1 year. Then only we can call it a short term. Okay. Now the person comes, when he wants to come India and invest money. Okay, what will be his stepwise process? The first step that he has to take is sell dollar and buy rupees. So the buying rupees here is very important. Okay, then use that rupee, okay, whatever he bought, to buy Nifty. For example, he wants to invest in Nifty. So if you see here carefully, two things are happening. Number one, selling dollar, selling home currency and buying rupees. Okay, and using those rupees to buy Nifty. His total returns would be maximized if both these assets which he bought appreciates. And if I on the basis of analogy, if I use this concept, then you will have to keep in mind that whenever a person invests in another country, you know what will happen? Correct. Whenever a person invests in other country, in order to get higher returns, okay, foreign currency should appreciate, okay, and the asset in which he invested should also appreciate basically. So in my example, okay, suppose $1 lakh converted at the rate of, suppose, what rate is that? 40. So you get 40 lakh rupees, and they say that he invested the corresponding proceeds in the Nifty, in which was trading at 4,000. Okay. So 40 lakh divided by 4,000 will give you 1,000 units of Nifty. After 1 year, he sells those 1,000 units at a price of 4800. Find out the return to the US investor in dollar terms. So basically 4800 into 1,000 will give you 48 lakh rupees. Okay. So for 48 lakh rupees divided by, we don't have a rate here. So now rupees 48 lakh is the final amount that needs to be converted in dollar. Use your common sense and tell me whether you are going to divide with a rate or multiply with a rate. I can answer that part. If rupee is to be converted in dollar, then you will have to divide. This question is supposed to be answered by you. So tell me whether you would like to have a lower rate or a higher rate so that he can earn a higher return. Quickly. If you give me that answer, we are sorted with the topic. Tell me quickly, in order to maximize his return, the rate, it has to be a lower rate. Okay, the rate at which he got was 40. So he would earn more if it is 40 more or less. Lower, because rupees 48 lakhs divided by lower rate. Correct, we get more. Correct, Viru. Okay, so we get more. So if the rate is suppose 37 or 38 or 39 maybe, so he would get more dollars because of that. Yeah, that's how you can think mathematically. And one more question from my side. And rupee 40 per dollar spot becoming rupees 38 per dollar after 1 year is called what? Rupee appreciate or rupee depreciate? Please use your brain and then only answer me. Rupees 40 per dollar spot becoming rupees 38 rupees 1 year after. How would you interpret this? You would call rupee appreciate or rupee depreciate? Appreciate. Very good. It is called rupee appreciate, correct? Because in the spot market, appreciate. Yes, very good, very good. Okay, now you got it. That means if when you invest in another country, in order to maximize the return, the foreign currency should appreciate and the asset should also appreciate. Question: a US fund bought, so it is done. So here for a US fund, look at this carefully. For a US fund, rupee appreciate. It is a foreign currency. Okay, so the equation is 1 plus RFA 1 plus RFC minus 1 into 100. So RFA means return on the asset, 4800 minus 4000, it gives you 20%. Then rupee appreciate by 8%. So 1.20, okay, plus into 1.08, there are a lot of logics. Don't get into that at this point of time because the portion is huge. Correct, correct. Okay, so 29.6%. Now if rupee depreciates, then you get 10.40%. I've given you a lengthy method also, guys. You can go through at home. I'm not discussing here. This is something that you don't need to write in the paper, but this is good in order to understand your portion. This method is good. Same calculations. In the examination, you are going to do this method only, not the lengthy method for that matter. But if you go through this method too, at home, quietly, peacefully, you will be able to understand method 1 all the more better. So whenever a national is investing in a foreign country, then he basically does 2 purchases. Number 1, he sells his home currency, buys foreign currency, and he also buys an asset which is denominated in foreign currency. Okay, so the formula is 1 plus RFA 1 plus RFC, the whole minus 1 into 100. But be careful that here you should focus on foreign currency appreciation, not home currency, because if home currency appreciates, 40 will become 45, and if you divide 48 lakhs with 45, then you will not get more dollars, you will get less dollars. So maybe you can combine your conceptual and mathematical understanding to understand better. Okay, now the next topic is this one. Okay, for this, that was foreign currency investment short term. This is long term, guys. Okay, what did I say? Not long term, borrowing. That was investment, that this is borrowing. Long term is still pending. I think I'm getting tired thoda, because of so many lectures. No, your brain starts getting foggy. Not really. Okay, but then yeah, slight. Now the students can say, okay. Okay, start again. Okay, now the one you did was of investment, now this is of borrowing. So basically IRP says that, careful, IRP says that if all factors stay constant, okay, then the effective cost of borrowing from any country should be the same. When I say all factors stay constant, that means there should be no transaction cost like brokerage, then commission, then what do you say, the bid ask spread and all the taxes, STT, it shouldn't be there. You can question me, ma'am, why? I give you one example and you are sorted. So if here rupee rate and dollar rate is given 10 and 6%, okay, so as per IRP, the country having the lower rate should trade at a forward premium, correct? So how much premium? Approximately 4%. So basically if you borrow from India, you pay 10%, okay, and if IRP holds good, then what will happen? You will borrow, if you want to borrow in dollar, assuming that you are going to pay lower cost, it will not happen like that if IRP holds good. Why? I tell you, because if you borrow at 6%, okay, for whatever maturity, maybe like 1 year, to keep the example simple, after 1 year dollar will appreciate by 4% if IRP is holding good. So 6% is your interest cost and 4% will be your fluctuation cost. So 6 plus 4 becomes 10%, like that. Okay, similarly, if you compare rupee and yen, okay, it's a very weird because yen cannot have 20% at all. This is a third world country interest rate. Okay, so if you compare rupee and yen, then what will happen? So basically what happens, I tell you, if you, in case of rupee and dollar, the principal component increases when you go to return money. I gave you an example yesterday only in the last lecture. Okay, but in case of rupee and yen borrowing, so rupee is 10 and yen is 20. So if you borrow at 20, what will happen? And if you borrow at 20, this time your currency will be at premium. Okay, so as a result of that, whatever you have borrowed, the principal component will go down, not more. If you compare rupee and dollar, your principal component will increase so much so that the differential benefit that you created because of the interest rate 4%, you will lose that 4% on the name of the principal on the exchange. Similarly, if we compare rupee and yen, then what will happen? You will pay less in terms of the principal when you go to return money, and that gain will decrease your cost from 20% to 10%. Okay, so we are sorted here. So I just try to prove this is not an institute question, guys. This is just to help you understand what exactly I'm trying to explain you. So look at this. Dollar cost, suppose I borrow, rupee borrowing 10%, dollar borrowing, dollar cost is 6%, then premium on dollar 1 plus IA minus 1 plus IB divided by 1 plus IB, 3.77%, and then combine this whole thing, 1.06 and like that, and you get this answer. Similarly, for yen borrowing, it is 20%, and again if you compute this, you will get minus 8.33% this time. I told you that. Okay, and when you combine 20 and 8.33, again you get 10%. But then this is only possible when all the possibilities of, when variables are constant. Okay, only variable is the interest rate, keeping other factors like tax, transaction costs are not there only. I have given one more question of same variety but with transaction cost. I saw one question of this kind, okay, in a very old RTP actually. So previously I used to teach, then I used to think, okay, they are not asking in the paper, please I can drop it. Okay, let's not teach too much because the students will get bothered unnecessary. But then when I was doing some R&D on the content part of last 20 years paper and everything, I found that there was one question in the RTP. That means it is there. So now if it is there, you have to study that. It's as simple. Suppose in the previous sum there is a processing upfront fee. Now the transaction costs are coming. That means you do not have rates, you have some transaction cost associated with those borrowing. Okay, so in rupee borrowing you have a processing cost. I'll explain you, give me 2 minutes once I read the whole question. Also in Indian government, he announced a withholding tax of 15%. Yeah, but Virendra, Viru, you need to be specific in your doubt, which you can ask me later on, not a problem. Okay, and have you heard of withholding taxes? So when you, I'm sure you have done direct tax paper because you are in, you are already going to appear for the examinations. Okay, so in direct tax there is a chapter called TDS, if you remember at all. So withholding taxes can be of two types. Suppose I am an Indian, I want to go and invest in USA. Okay, so suppose I invest some amount, I earn something there. So the US government will slash out something from the return component, not the principal component. That is not allowed. Okay, so that is called withholding tax when I go to invest. That's very easily understandable because you are going to some another country. Okay, you are going to some other country. Okay, and there if you go and invest there, obviously the government would ask for some tax because you have invested, earned money in their country. That is called withholding tax. Withholding tax will reduce your returns. Okay, and then if again you come to India with that return, again the Indian government slashes out the tax part, then your motivation to go abroad and invest money will come down because the extra return that you earned was paid in the form of the tax only, and you are normalized with the normal return. In order to avoid that demotivation, two governments can come into an arrangement called double tax avoidance. Okay, double tax avoidance treaty. So with countries, they decide on an effective tax. For example, they say that combined together, the investor should not pay more than 30%. So maybe it can be 20, 10, depends on the arrangement. And suppose if you already paid 30 or 40 if you paid there, then maybe 10% you will get reimbursement or something that sort. Okay, that is withholding tax in case of investments. In case of borrowing, withholding tax stands for the fact that Guys, if you borrow in India and if you do not return money, you know what will happen? If you borrow in India and if you do not return money, then what happens? The money, it is within the country, it doesn't bother the government at all. Money with you, money with me, money with somebody else. But when you borrow from outside country and when you do not return, then government will be in a problem because the balance of payment will get affected. And because in order to avoid such kind of incidents or events, what government can do, it can levy withholding tax on the borrowing part. So what does it say? It says that suppose if you want to go and borrow money from outside, I will maybe like levy 15% of withholding tax. What do you mean by that? If you borrow maybe like if I need 85, I will have to borrow 100. Why? If I borrow 100, when I come back in India with that money, the government will withhold 15% of my money. That means though I borrowed 100, I will pay interest on 100, okay, but I will be able to utilize only 85, okay. But because of that extra borrowing, what will happen? My interest effective cost will increase. But while returning back, government will release that 15. That is called withholding tax when you are borrowing money. Okay, I hope you understood this part. So what will be the cost with all the charges? Okay, so interest cost is 10%. Interest cost is suppose 10%. You borrow 100. Processing fee 2%, what you get from the bank is 98. But do not forget one thing, you will pay interest on 100 and you will return also 100. Okay, so look at this, 10 plus 100 minus 98 by 98 makes it to 12.24%. That means just because of that processing fee of 2%, your cost increased from 10% to 12.24%. Then you have dollar borrowing. Can you see here? If 6 is for 85, what is 6? 6 is the interest rate for dollar. If 6 is for 85, then what will you have to pay for 100? Did you get the point? This is not a rate. This is not interest rate. It is please try to differentiate between a rate and an effective cost. They are different. Okay. Effective cost is combining everything. Here you needed only 85. Or maybe can you think like this? Maybe like if I need 100, I'll have to borrow 115. Okay. So if I would have, suppose the withholding tax was not there, I would have paid 6. Okay. So, but now I'll have to pay for 115. So 115 into 6% gives you 6.9, which is approximately 7. Are you getting the point? So basically because of the withholding tax, your cost is increasing from 6 to 7.09%. Okay. And that is how. So if 6 by 85, if 6 is for 85, then what is for 100? 7.06. This is effective cost. And then combine the premium component. Be careful. We are not taking 7.06 while computing the premium component. These two are different. You just combine to get an answer. Okay. Withholding tax has nothing to do with the dollar premium. Why? Okay. Now going ahead, guys, this is the final answer. Same for this. Now you can compare 12.24, 11.096 and 13.24 to understand that which would be a better way of borrowing. Because see, when IRP was holding good, we knew by default that when IRP will hold good when there are no transaction cost. But this question is with transaction cost. Here you cannot say with guarantee, okay, everywhere I get 10%. No. You will have to calculate and you will have to tell the effective cost in each one of them. And here all three are different. They cannot be 10 because the implications of the transaction cost would be very, very different. So here what I understand is that dollar borrowing would be the best out of all the three options. Guys, you now need to respond. How's it going? Are you comfortable, all of you? I think it should be ideally. Are you fine, all of you? Are you fine, all of you? Can I start with a new topic, long-term investment? Comfortable, ma'am. Okay, great, great, very good. So long-term investment. Again, I want to speak something here is that till 2018, I've been teaching this subject since last 16 years non-stop. I mean, it has been really non-stop journey. Okay. Now, this topic used to be a part of curriculum always. It was like always there. But in 2018, SFM underwent change. The curriculum that you are following at this point of time. Okay. The index, the topics in the index, the names were changed for that matter. Okay, so what happened, they changed the name of the topic from, like, it was forex, foreign exchange topic, and everything was to be studied there only. But in 2018, when the new SFM was launched, okay, they segregated the chapter into two parts. So one was forex, normal, what you're studying, and the another topic was IFM. Okay, so IFM is international financial management. So basically what I want to tell you is that it is nothing but investment in another country for long term. So you did for short term. Now you have to do long term. So when the word comes long term, automatically the word should be capital budgeting or a project. So this is a separate topic that we have to study, that we are going to do tomorrow. Possible, you know, kind of. I'm just thinking that how much portion would be covered today for that matter. Okay, and accordingly we can take a call tomorrow. We'll first finish this thing. So now I'm not like seeing, I'm not looking at the, you know, tomorrow's or day after tomorrow's lecture. I'm just saying that let's let it go on the way it is going as per my physical comfort, not mental comfort. Mental comfort I'm very strong, but physical is something that might be like I'll have to like take calls quite often, because as I told you, while taking the Hindi fast track, I did not, none of the batches, like I was quite comfortable because batches had not started. But while I'm doing this, all the batches have already started, so it is like 8 to 9 hours of lecture on a daily basis, which is okay. I'm not like I'm not doing any obligation on you. This is of my free will. Okay, you don't have to feel bad about that. But the only thing is that I feel that maybe like half an hour, 1 hour here and there, I keep like reducing and increasing depending on my physical comfort. Okay, and then accordingly we can go ahead. But finishing the portion, that's why I told you in the last lecture, guys, 2-3 days here and there, please cooperate, because, and you can bear, because I want, but then maybe like I'm not able to speak, maybe I'm tired very much, so maybe I'll take that like some breaks and then teach, and I'll be able to finish it properly. Okay, I hope you understand and you appreciate that part. So this week has been really very hectic for me, very hectic. Okay, so I am not wanting to keep the topic completely untouched for tomorrow only. I am going to start this topic because it is on the way. Learn some here, maybe some of it, maybe tomorrow will take very little time to complete this topic because the basics would be done. Okay, now what I want to tell you is that, guys, when you do a question of long term international, so it is a capital budgeting. The only difference is that when you put up a project in your own country, there is no foreign currency thing. So it is exactly same, all the concepts, all the logics would be same only, there would be no change at all. So what you have to understand is that only the conversion part would be there, nothing else, guys. And always the project will be for more than 1 year. Okay, so DK Limited is considering an investment proposal. Okay, so 2 things please remember. Number 1, look for your discounting factor, KC. What is the topic after that? Purchasing power parity. These things will not take too much of time. Let me check what are the, okay guys, so we will do till here, guys. We will do till here today. Okay, and tomorrow we can do fate of forward contracts. I think that will work, because that will be again a very lengthy topic, and I feel I teach that topic very beautifully. Okay, so let's do up to here. Okay, whatever time it gets over, let's complete the topic till here. I hope that works, right? That will not take too much of time, I feel. That's what I think. Okay, so now coming back here, 2 things you have to remember. When you start the question of long-term international project appraisal, look for your discounting factor, KC. The second thing that you should look for is the exchange rate. So in order to, they will never give the exchange rate, because the project will be of 4 years, 5 years, something like that. They will not give the exchange rate. What they will give, They will give you a spot rate and they will give you 2 interest rates or 2 inflation rates. Okay, so what will you do? If it is an inflation, you will use IRP, and if it is inflation, you will use PPP to compute the exchange rates for the another 5 years. I hope you get it, right? So let's read the question. These 2 things, if you can hold on, you can solve any question of IFM, International Financial Management. Okay, so DK Limited is considering an investment proposal in Sri Lanka. No, Mansa, no, these are not enough. These are not enough, sweetheart. No, they are not enough, because you'll have to take few more sums actually. This sheet has been designed in order to teach you all the concepts. The questions which I have chosen are like very latest questions, last 2 years question only, of course. But then you need to do some more difficult level questions also. Okay. So DK Limited, yeah, but the sheet will give you a revision for concepts. That you can do. You can revise all the concepts using this sheet, and then you can do a few questions more. So DK Limited is considering an investment proposal in Sri Lanka involving, yeah, an initial investment of LKR 25 billion. Don't be afraid. The current spot exchange rate is INR LKR 0.37. That means rupee 0.37 per Sri Lankan rupee. The risk-free rate is in India is 6% and same in Sri Lanka is 5.02%. So what I got till now is a spot. The risk-free rate in India is 6%. So okay, I rupee is 6 and I LKR is 5.02. Possible? The project will generate a cash flow of Sri Lankan rupee 5 billion in the first year. The cash flows will increase by LKR 1 billion each year. That means 5, 6, 7, 8. The project will wind up, not bind up, on the completion of 5 years with no salvage value. The required rate of return on the project is 8%. You are required to find out the investment worth of the project by home currency approach and foreign currency approach. I will not speak anything theory. Okay, look at this now. Home currency approach means, so basically DK Limited is an Indian company. They are wanting to put up a project in Sri Lanka. Okay, and the initial investment would be 25 billion Sri Lankan rupees and the cash flows are given. They are wanting you to calculate NPV from home currency approach, means in terms of rupee. They are also wanting you to calculate the NPV in Sri Lankan foreign currency approach. How to approach this question? Look at this. They given the PV values and everything. So first of all, if you want to compute the, don't you think that in order to compute NPV in domestic currency approach, you would need to convert your Sri Lankan rupees into Indian rupees, correct? And for that you need a exchange rate. They have given you 2 interest rate and hence you will use IRP for that. Look at this. Nothing is written, spot into 1 plus IA by 1 plus IB. IA is rupees and IB is your Sri Lanka rupees. Okay. So these are the rates they calculated. Now they have given in the home currency approach, if you see here, if you see home currency approach guys, you will see that they have given you 5 years of cash flows, positive cash flows. 5 is given and then increase by 1, you get this. You convert it using the rates that you calculated. Okay, and then you get this in rupees. Nothing you have to do. 8% is already given in the question. Okay, convert and you get the answer. I am 100% sure that none of the students would want an explanation to this, because all of you know how to do that. The only thing that I want to teach you in this question is that, and I think I should teach you that and finish it off. So I don't know whether you know this or not. Any ROR or any rate for that matter, okay, ROR or rate for that matter has got 3 parts, maybe 2 parts I can say, RF and risk premium. So this 8 is what? This 8 is ROR or RF? Can you say that? I think you can answer it is an ROR, right? but they've given RF for two countries, and RF for India is 6, okay, and Sri Lanka is 5.02. So guys, don't you understand that if RF for India is 6, so I rupee RF is 6, okay, and I Sri Lanka LKR, okay, is 5.02. Are you not getting? And the discounting factor, always remember one thing, in this kind of question, this any rate which is given 8%, like, you will always use for the home currency, because obviously DK Limited is an Indian company. It knows what rate of discounting to be used. It knows what rate of discounting to be used for that matter, right? It does not know for Sri Lanka, but I can always calculate. How? In a layman's language, if India's RF is 6% and the ROR from the project is 8%, that means the risk premium component is 2%. And I assume that the risk element perceived by Indian shareholder and Sri Lankan shareholder in the same project would be the same. So can I not apply that 2% to 5.02 and make it the ROR for the Sri Lankan investors? Yes, but it will not be that simple plus minus. Rather, you will have to discount and compound. Look at this. Foreign currency approach, you will have to 1.06, okay, and this should be equal to 1.08. So basically what are you doing? You're calculating this. If you know what something guys, if you remove -1 and into 100, it will give you 1.887, which is equal to 2% that I told you 2 minutes back. But since the method I used was plus and minus, here they are using compounding discounting, you will not get 2, it will be slightly lower than 2. And then apply on that rate to compute the ROR 7%. Nothing you have to do. Just no conversion required. Use that rate of 7% discount and compute the NPV and you are sorted. Ask me doubts if you have, please. Please ask me doubts if you have. Guys, I think you need to revise also the portions. I personally feel that you should be revising. Are you able to revise? Because I mean, you did not get time to revise, of course. But revision would be important, very, very important. Because we are having lectures back to back since yesterday. I'm only thinking that whether you are keeping a control or you are getting tired, because this is a vast topic. The students cannot control so much of it at one shot. Maybe like if it was today's evening also, you would have gotten some breather. For example, like it is back to back coming. So are you able to manage that? I'm just asking. I am just, that is what I'm thinking, that it is like a bit getting over actually since last night and back to back. It is okay if it gets extended to one more day, it is completely okay. But then if you are not able to take it, because I am thinking that since I am ready to teach you for one more hour, but then the point is that will it give you that kind of, so if you are comfortable, then I stop it here today, revise the whole portion since what we have done since yesterday, and get into control, and then we start the lecture again tomorrow evening. Does that work? Because I am there, I will not leave you in between, don't have to worry. Here and there I will not stretch it also too far, don't have to worry about that. But I'm only thinking from your perspective that will you be able to digest so much, because almost like I'm giving you a lot, I don't know how much are you able to swallow. So should I give you a pause today? Maybe tomorrow we can meet 7 o'clock, so that you don't get, I see, the most important thing at this point of time, is to hold on. Okay, I just because we want to complete the targets of a particular date, it should not become diminishing marginal utility. Okay, So you need to revise and be the moment you come for the lecture, you should be like, okay, this much is done. Now I'm going to learn something new. But I'm already giving you a lot. I don't know how much of you are able to swallow also, because today was a bit hectic. I can also feel from my side also that I'm feeling tired. Right, yes, that's what I feel actually. We have covered quite a lot. IRP is already over. Sit down, revise, do a few questions from whatever classes you have done. Okay. At least try out them. Take a breather, take some space inside that. Okay. So let's stop it. Let's not start a new topic now. Guys, and you can ask me doubts also after that. We are on the group. I'm active on the group. You can ask me any doubt if you feel like, but relax, take a breath. I feel it is getting a bit more actually. Yeah, it is useless. Basically, correct Viru, because that is why you are not see, I get to know on the basis of your response. Yesterday you were very active because it started and you could take it. But since today morning, I'm and I could feel. See, you are not in front of me, but there is some kind of vibration. I can feel that the students are getting tired. They are not. They are trying hard to align with me, but they are not able to, possibly because they are tired and not get time to revise. So okay, let's stop it. It's okay, tomorrow evening we meet. Okay, please, at least you guys, kind of give time and revise forex. Will you be able to do it by tomorrow? Whatever I have taught, don't go ahead, don't learn anything extra. Will you be able to revise whatever I have taught, because it's already almost like 5-6 hours of lecture since yesterday. No, it is okay, it is okay. Just tell me whether you will be able to revise. Yeah, okay. Okay, some people are saying, you're talking now, Arun. No, no, it is okay. I see, we are professionals and we need to behave accordingly, right? So it is my, and some professions have a lot of responsibility. Some of them are, because there is something morality, moral ethics are a bit on a higher side in some professions like mine. So I cannot use my situation to your disadvantage. I'll have to use for advantage. Okay, so, and I'm there. Don't have to worry. Relax. You need time to revise. I know. So bye bye. Bye bye. Take care. Revise and come tomorrow. We are meeting at 7 tomorrow evening. So I'm giving you almost like more than 24 hours to revise. Please revise. I could feel that actually, because you were not responding. So I could feel that it is now you are drifting from me. I could make out that. Chalo, bye bye. Take care. Relax.